When headlines worry you, bank on investment principles. Hi, and welcome back to another Money Not Math conversation. This is conversation number 139. It is Thursday, April 27th. Hope everyone's doing well, and I appreciate you taking the time to watch or listen to this conversation today. I hope it brings you value. I hope the Vikings make a decent pick tonight, and hopefully the Wild can pull their heads out of their butts and play better tomorrow. But anyways, let's get back to Money Not Math conversation. In today's conversation, I am reviewing an article from Dimensional. And like I said, it is talking about when headlines worry you, bank on investment principles. On Friday, March 10th, regulators took control of Silicon Valley Bank as a run on the bank unfolded. 2 days later, regulators took control of a second lender, Signature Bank. With increasing anxiety, many investors are eyeing their portfolios for exposure to these and other regional banks. Rather than rummaging through your portfolio looking for trouble when headlines make you anxious, turn instead to your investment plan. Hopefully, your plan is designed with your long term goals in mind and is based on principles that you can stick with, given your personal risk tolerance. While every investor's plan is a bit different, ignoring headlines and focusing on the following time tested principles may help you avoid making short sighted missteps. First, uncertainty is unavoidable. Remember that uncertainty is nothing new and investing comes with risks. Consider the events of the last 3 years alone: a global pandemic, the Russian invasion of Ukraine, spiking inflation, and ongoing recession fears. In other words, it may have seemed as if there were plenty of reasons to panic. Despite these concerns, for 3 years ending February 28th, 2023, so February 28th, 2020, 2002 to February 28th, 2023, that 3 year period, the Russell 3000 index, which is a broad market capitalization weighted index of the public US companies, so basically the 3,000 largest companies in the United States, returned an annualized 11.79%, slightly outpacing its average annualized returns of 11.65%. So it actually did better over the last 3 years than its average during those three things that were talked about: the Russian invasion of Ukraine, the global pandemic of COVID, and all those shutdowns that came with it, and spiking inflation. All right. So can you see where the news doesn't necessarily align with returns? The past 3 years certainly make a case for weathering short-term ups and downs and sticking with your plan. Number two, market timing is futile. Inevitably, when events turn bleak and headlines warn of worse to come, some investors' thoughts turn to market timing. The idea of using short-term strategies to avoid near-term pain without missing out on long-term gains is seductive, but research repeatedly demonstrates that timing strategies are not effective. The impact of miscalculating your timing strategy can far outweigh the perceived benefits. Number three, diversification is your buddy. Nobel laureate Merton Miller famously used to say, diversification is your buddy. Thanks to financial innovations over the last century in the form of mutual funds and later ETFs, known as exchange traded funds, which, for those wondering, are a little bit more tax advantaged way of investing like a mutual fund, depending on the situation. Most investors can access broadly diversified investment strategies at very low costs. While not all risks, including a systematic risk such as an economic recession, can be diversified away, diversification is still an incredibly effective tool for reducing many risks investors face. In particular, diversification can reduce the potential pain caused by the poor performance of a single company, industry, or country. As of February 28th, Silicon Valley Bank represented just 0.04% of the Russell 3000, while regional banks represented approximately 1.7%. For investors with globally diversified portfolios, exposure to Silicon Valley Bank and other US based regional banks likely was significantly smaller. If buddying up with diversification is part of your investment plan, headline moments can help drive home the long term benefits of your approach. So let's think about that for a second. Silicon Valley Bank only represented 0.04% of the Russell 3000. So if you let's say all your money was in the Russell 3000, when that bank failed, that only represented 0.04% of your investment, right? So it's not as big of a deal as the media likes to make it out to be, because they need stories to sell. And if you're globally diversified, it's even less of an impact. So again, for every one really negative story, there's a whole bunch of companies out there working really hard to make a profit that are driving returns if you stick to long-term principles. While the unexpected happens, many investors feel like they should be doing something with their portfolios. Often, headlines and pundits stoke those sentiments with predictions of more doom and gloom. For the long term investor, however, planning for what can happen is far more powerful than trying to predict what will happen. And this is extremely important because motion and psychology tells us when things are going wrong, we have to do something to fix it. When oftentimes the hardest thing to do is nothing, and oftentimes that's the best thing. All right. The fourth thing I'm going to add to this that's not in the article, but I think is extremely important is build your war chest. All right. Have money set aside that's not dependent on the market so that you, whether the market's doing this or this or this, you aren't emotionally affected by what it's doing because you know in the short term you have a war chest to protect yourself against market fluctuations so that you can allow your long-term investments to do what they do best over a long period of time. All right, so that's Money Not Math conversation number 139. Thanks for taking the time to watch or listen. Please let me know what you think by commenting or reaching out directly. And if you really enjoyed it, please like and share this post with someone you know. Thanks and have a great day. Bye.